In today's video, I'm going to be going over 6 more extremely common charting patterns that all beginners should be able to know, recognize, and trade. If you haven't watched part 1 of this series yet, I would highly recommend you do that. In the first part, I go over 5 other technical analysis patterns, including triangles and flags. And watching and understanding that video before this one will help you understand these concepts better as well. Throughout this video, I'll show you sketch drawings like the one you're currently looking at, as well as real examples of rising wedges, falling wedges, double bottoms, double tops, head and shoulders, and inverse head and shoulders. That includes 3 bullish and 3 bearish patterns. If you don't know how to identify or trade these patterns, you're definitely watching the right video, and by the end, you're going to be an expert in all 6 of them and be able to trade and understand and see them yourself. Now, real quick before we get started, if you like the content in this video and want to see more similar content, do me a favor and click that like and subscribe buttons below. This helps support my channel a ton, and it lets me know which videos you like so that I can create more similar ones. All of the content posted on my channel will help you become a better day trader, so why not hit that subscribe button and get more content you'll love. So with all that being said, let's dive into the first pattern, and they're called rising wedges. Now, in part 1 of this tutorial series, I taught you about higher highs, higher lows, lower highs, and lower lows. This is essentially just referring to each of the peaks in the market. So if the highs up here are increasing, like they are here, we have higher highs. And obviously if they were decreasing, we'd have lower highs. And then similarly on the downside here, if the lows here and here are increasing in price, which they are in my example, we have higher lows. Otherwise, we'd have lower lows. In a rising wedge, we need to have higher highs and higher lows. So you can see that each of the lows is higher than the previous one in price, and each of the highs is also higher than the previous one in price. That's condition number 1 for a rising wedge. Condition number 2 is that we need to be able to connect some sort of trend lines, like the 2 blue lines that I have drawn, and these trend lines need to be converging towards each other. In other words, the distance between them needs to be decreasing over time. So you can see there's a huge distance between the 2 lines all the way back here. And as we approach the end of the 2 lines that I have drawn right now, you can see the distance between these is extremely small and they're close together. The point where they actually would meet is called an apex. And oftentimes we'll see these rising wedges have their breakout at or near the apex, though it doesn't have to be. So when you have a pattern like a rising wedge, which comes in an uptrend due to the higher highs and higher lows, you're actually looking for a bearish break of this pattern to take puts or shorts on the ticker or coin or anything you want. So the bearish trade might actually look something like this, where we have all these higher highs and higher lows, and then we're coming down once more, and instead of using this trend line once again, we actually break through it and we fall significantly downwards afterwards, something that would look like this. As soon as we get this confirmed break below the trend line, this is when you want to enter the trade. These rising wedges often fall downwards extremely quickly, so if you hesitate or you wait too long, the trade will probably be all the way down here already and your risk to reward won't be as good. If you simply take the trade when you notice the breakout of the trend line happening inside of this circle that I'm drawing, you can have your stop loss just back on the other side of the trend line, so it's not that far away. Something like this much for your stop loss. And oftentimes in these rising wedges, you can have a target that's the first pivot of the rising wedge. So all the way down here would be our target. So you can see that if you bought the breakout, even if you missed it by a candle or two and you bought it inside of this square right here, and you took a short position at this point, your stop loss would be just above the trend line. As I was saying, if we reestablish inside of the trend line, then this is likely a fake breakout to the downside and you'll want to exit the trade. So your stop loss would look something like this, and your target is something like this, all the way down here. So you can see on this trade, we have almost 8-to-1 risk to reward. This is an excellent trade to take. So let's look at a real example of a rising wedge. So I'm going to show you this example on Google on the 17-minute time frame here. However, all of these patterns can be used on any asset of your choice, whether it's stocks, options, crypto, forex, futures, or anything else you might want to trade. It will work on all of those assets on any time frame, whether it's the 1 minute, the 17-minute, the 2 hour, the 1 day, the 1 week, any of them. They'll all work, and these patterns will all happen all the time. But let me just show you this on Google right here. When you start to see price action that looks like higher highs and higher lows in here, but it's also somewhat trending sideways, you'll want to start drawing and connecting trend lines and seeing how the trend lines actually look. So when I'm looking at this price action through here, I'm going to connect a trend line from our first low to our second low through here and just pull this sideways. And then I'll adjust the trend line a little bit so we can actually catch some of these other lows in here as well. It's okay if we get these small wicks through the trend line or if they're not perfect completely. And then I'm going to do the same thing on the top side here. So I'll connect the first high in here to the second high in here and pull this one sideways. And you can see that we do get a breakout above this rising wedge that we have right here, but we fall right back into it, into the pattern. So we have this low, this high, a higher low, a higher high, another higher low, another higher high, higher low, and this is actually where we fail to put in that higher high, and we fall below the trend line on this red candle right in here. So once we have this red candle in right here, it has pretty good volume, it has a full close below our trend line. This is the spot where you want to take a short entry. And you can see, of course, in hindsight, that if you did take that short entry, we did fall all the way down to that target that I was telling you about, the first pivot of our rising wedge right here. So if you took a short position around here, around 2100 on Google, you would have had an easy trade to the downside to about 2013, about 85 points on Google right here. And we even ended up going a little bit lower than that, down to 1990, another 25 points downward, but this would have been your first target of the trade. The second pattern I'm going to show you here is essentially the exact opposite of rising wedges, and they're known as falling wedges. They have the same sort of characteristics, where the breakouts of these falling wedges are extremely quick and sharp and usually target, again, that first pivot of the falling wedge. However, this time it's actually a bullish breakout that we're looking for. So if we have a pattern like this, where now we actually have lower highs and lower lows, so each of the bottom pivots is decreasing and so are each of the top pivots, we would look for a breakout to the upside that looks like this. And the entry conditions are exactly the same on this one. Once we get a confirmed break above the top blue line right here, we would take a long or call or bullish position on the stock or crypto or coin or anything that you're trading and target to the upside. So let's go ahead and take a look at a falling wedge in action. So once again, I'm going to use Google for this example, and once again the 17-minute chart. And again, I see this sort of sideways price action here, but I notice that there's lower highs and lower lows being put in over and over throughout all of this price action right here. So let's connect it with some trend lines. We'll use just our first two pivots that I can see a lower high on, so this high and this high right here, and we'll pull that as a trend line through here. And then I'll do the same thing on the bottom side right here. I'll just connect the pivots that fall inside of that trend line that I've already drawn. So those two lows inside of here. And then we'll pull this sideways just to make it look nicer and look more like a triangle. And you can see this looks exactly like our rising wedge pattern, but basically upside down, where we have this high, this lower high, lower low, lower high, lower low, lower high, and then this is where we fail to put in that lower low, and instead we go up and break the trend line again. So once again, this candle right here on the breakout that we have a strong amount of volume on and a great candle close above it, this is where you want to take a long position and target as your first target the first pivot of our falling wedge, which is up here around 2113 on Google. So had you taken a long right here, somewhere around 2040 or 2045, you would have easily gotten your first target at 2113, and we actually ended up going significantly further than that on Google. Our third pattern that we're going to go over is called a double bottom. A double bottom is basically signified when you have a drop in price, like this one right here, and it puts in a low, and then we get some sort of a reversal upwards up to some price up here. We get one more push downwards, and we actually come to that exact same low or very similar to it. It can be within a couple percentage, so up here or maybe a little bit below it down to here, but roughly the same low as this one. And then right afterwards, we break upwards again and break out past that original spot where we had originally put in a high. So we get a low, a lower high relative to our previous price action, a similar low, and then a higher high relative to this one. A really good way to identify this double bottom pattern is by looking at it as a W shape. You can see that it actually spells out the letter W with the double bottom pattern. Once a double bottom pattern is formed, the bottom down here is now an extremely strong support. So anytime we come to this in the future, we know this support line down here is going to be strong and we can play another bounce off of it again. The other thing to note is that these double bottom patterns come at the bottom of a downtrend. So oftentimes we'll have price that's downtrending for quite a while that looks something like this, and then we get the double bottom pattern that comes in just like this, and it ends our downtrend and starts the uptrend. And the way to play this double bottom pattern is the breakout of that first high of the middle of our W right here. So as price is coming up here, it forms this high, it hits the double bottom. Once we get back up to here and we break this resistance right here, this is where you want to enter the trade. So once we get that candle close through this spot right here, this is where you take a long position to the upside. So of course, let's dive into a real example of this one. So I have Spotify open here on the 2-hour chart just to change it up a bit, and I'm zoomed back a bit in time into the middle of 2019 right here. And this example is interesting because I actually think there's a double bottom inside of a double bottom on Spotify right here. The very first one that I notice right here is this W shape that we form right here. You can see we get this first drop right here, a push upwards that doesn't make a new high, another drop right there, which goes to almost the exact same price level as this first drop right through here. And then finally, we get the breakout of this level, this midline right through here. On the first try up right here, we actually get a bit of a fake out. So you'll of course want to wait for that candle to close above and give you confirmation. And when it does, somewhere in here where we get that actual confirmation, that's when you want to buy this double bottom breakout to the upside. And of course, again, in hindsight, you can see that if you did buy this double bottom breakout right through here, Spotify flew from about $160 here quickly up to about $196, $197, and after a little bit more sideways movement, it even went way further upwards afterwards. So now you might have guessed what our next pattern is. It's a double top, and it's the exact opposite of a double bottom. So just to recap, we have an uptrend that goes on, and we get this nice move right here. We hit a peak finally in our uptrend, and we get a nice pullback from it, down for our first retracement right here. Then we head back up, but we don't break above this high. Of course, we can miss the high by a couple percent, similar to with a double bottom, or maybe break above it by just a little bit, something like this. But for the most part, the high is going to be very close to the previous one. We get this double top where our top forms twice, and then we break downwards to the downside afterwards. And just like with the double bottom, you'll want to play the double top as a breakout through that midline once again. And just like a double bottom formed a W, the double top, of course, forms an M, or an upside down W. So let's take a look at a real example of a double top. I have Square open here on the 1-hour chart now, and I'm zoomed back to just the end of December 2020 right here. If you want to challenge yourself, pause the video quickly and see if you can find the double top in the screen that I have posted right now. I'll give you just a second here if you want to hit that pause button, and now I'm going to move forward and show you where that double top actually is. So just like with the double bottom where you're looking for that W in order to identify the double bottom, with the double top, let's try and identify that M pattern. And I think you can see it relatively clear through here. We have the first move up of our M right here, the middle of our M, the second move up, and then finally the move downwards to finish our M. We get two highs in here that are almost exactly the same price, maybe within a few pennies of each other, and then a breakout of that middle point of our M to the downside over here. So if we just draw that line across our chart here for the middle part of our M right here, you can see that when price does come down to it, it actually uses it as support quite a few times, giving us a bit more confidence that we do have quite a bit of significant support to break through to the downside. And when we finally do, you could have taken a short position in here on Square, somewhere around 205 to 207, for a continued breakdown below 195 in here. It's not as protracted as a breakdown as our double bottom example was to the upside, but we still could get a nice trade out of it here. Next up is our fifth pattern, and it's called a head and shoulders. A head and shoulders is made up of 3 different peaks, where we have peak number 1 here, peak number 2 here in the middle, and then peak number 3 right here. Now this pattern, you can actually use a TradingView tool if you're using TradingView to put it onto your chart. On the sixth icon down on the left-hand side right here, you'll go ahead and click the arrow next to it, and you can click head and shoulders, and then you can draw this onto your chart and it'll fill it in for you. So we'll click and draw it in just so you can see what I'm talking about here. And there you go. That's a colored in version of our head and shoulders pattern. Now we call this a head and shoulders because we have a shoulder right here, as you can see identified with left shoulder. We have a second shoulder right here, identified with the right shoulder, and then we have the head up here. And the only other naming part of this pattern that you need to know is the bottom line right here that connects between the shoulders and the head and goes all the way across. It'd be the trend line that is something like this. And we call this blue line the neckline. The neckline is an important spot because this is where you're going to actually enter into the trade. Now, just like with our other patterns, the head and shoulders pattern comes at the top of an uptrend. So if we have price that's uptrending before this pattern happens, something like this, and then we start to form this head and shoulders pattern, just like we have right here, this would mark the signal of the end of the uptrend and the start of the downtrend. And you'd want to play the breakout of this head and shoulders below the neckline right here. So once we get our confirmed close below this blue neckline, that's when you want to take a short or put position as your trade. Now, preferably with our head and shoulders, the two shoulders come at the exact same price. However, sometimes it can be a little bit crooked, and you'll see that in this example of Shopify on the 1 hour chart that's actually forming right now. I'm going to use the TradingView tool to draw this one in just so it's a bit more clear as to what I'm drawing. I see this first peak right here as a left shoulder, and then we push upwards all the way up here for a head, where we come back down, and we're putting in another peak right here, which is at a similar height to that left shoulder. It is a little bit lower, but that's what the right shoulder looks like for now, and that would finish our head and shoulders pattern. So maybe, since this actually hasn't fully played out yet, maybe our right shoulder will come up. It'll come up to this spot right here, and it'll look a little bit better so that our left and right shoulder are at the same price. However, for now, we can have it drawn like this. And we know that if Shopify continues to break downwards, the bottom line right here that connects all of this, also known as our neckline, this is where we're going to want to play this trade if we can get a bearish movement to the downside right here. So of course, we need price to fall quite a bit further in order for this head and shoulders to even play out. But if it does, and we get a break of this neckline right here, that's when you can take a short to continue it to the downside. And now for our sixth and final pattern, it's known as an inverted head and shoulders. It's the exact same thing as a head and shoulders, but it's upside down and it comes at the bottom of a downtrend. And it would signify the end of the downtrend and the start of the uptrend. So once again, if this pattern forms just like this at the bottom of a downtrend, you'll want to look for that neckline, which of course comes just like it does in the head and shoulders, and play the breakout of the neckline to the upside with calls or longs or a bullish position. So to finish up this video, let's show you an example of that. Now I think Snowflake on the 17-minute chart here is actually forming an inverted head and shoulders right now. We've been downtrending for quite a while on the stock, as you can see, and now we're potentially forming the reversal signal. With our left shoulder right into here, our head through here, and then our right shoulder might be this price action downwards that we've already had, or maybe it's still working on the right shoulder to put in a deeper shoulder into here, somewhere where the left shoulder would be. And I'll draw that in just in case that is what's happening. Though it's possible that our right shoulder is actually already in and the bottom of it is right into here. So you'll want to have this neckline drawn onto your chart right here and look for a breakout play of it, just like with our head and shoulders. You'll want to look out for the breakout of this neckline right here for a play to the upside on Snow. Now, since our right shoulder can come much lower before we actually do break out of this neckline right here, that's why I recommend waiting for the breakout to enter the trade, because we don't know how much further this is going to go downwards or how much longer either. If you made it this far in the video, I hope you now have a solid understanding of 6 more technical analysis patterns that you can use in your everyday trading. And if you did make it this far, it probably means you like this content and would want to see more similar content. So please do me a favor and click that like button below and hit subscribe for more similar future content on helping you become a better day trader. If you have any questions on any of these patterns, don't hesitate to leave a comment below and I will answer it as quickly as I can. And with that, thank you so much for watching, and as always, good luck trading.